Hello everyone and welcome to the latest eToro quarterly. We will review the previous quarter and preview the next. And it's a pleasure to be your host today and joined by three of our finest analysts. We have titled the quarterly as No Cut, Now What? So get your notepads ready, take the handbrake off and let's get into it. Just before we do take a moment to take a look at the disclaimer. Remember, this is a marketing communication and should not be taken as investment advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. As mentioned, we're joined by three legends of the game: Brett Kenwell, our US investment analyst; Jean-Paul, our global market analyst; and Neja, our market analyst as well. Jean-Paul, you're first up. And I think the best place for us to start this webinar or podcast, depending how people are watching or listening, is by reviewing exactly what happened in quarter two. So what did happen?
Yeah, a lot happened and the sentiment was positive again, I would say. After a strong first quarter, we had also a strong second quarter with earnings coming in above expectations. And we obviously have a look at rate cuts. But if we start with equities first, we saw the S&P 500 and the NASDAQ again setting all-time highs. And that was because earnings were expected previously by analysts to grow with 5% for the S&P, for example, but it came in at 8%. And if you look at sectors, it was particularly the semiconductor sector driving it. Everyone will know NVIDIA, but it's truly the broader semiconductor sector. If you look at, for example, the Philadelphia semiconductor index was up 30%. Now, where does this all come from? It comes from AI spent on data centers. Yeah, NVIDIA is a main profit from it. They profit from it, reaching a 3 billion market cap, which is quite memorable, becoming the largest stock of the world for the first time in their history. And the big tech companies keep on spending. You know, they upped their annual spending on research and development to over 200 billion. And a large chunk of that goes to AI data centers. Now, that's on company earnings. But if we look at the central banks, it's no cut. But that's not true for the ECB, because they did cut in the beginning of June from the deposit rate from 4% to 3.75. And as far as I can remember, it's the first time ever that the ECB cut before the Fed did. The Fed didn't do it yet, but we clearly saw economic data softening a bit. So we don't think any cut is off for now, but it's postponed till the third or the fourth quarter of this year. Well, where does it leave the other asset classes? The US dollar remained strong because there was no cut. So it gained in strength compared to, for example, the euro. Bond yields were flat, and the rotation to cyclicals that we talked about in the previous quarter, we believe that's been postponed. Now, if you look at specific asset categories, well, like I just said, you know, the Max 7, that cannot be a surprise that was the best performer in the quarter. A surprise to some may be that China takes the second place. You know, there's not a lot of investment going there, but perhaps just because it's a bit left aside. There's some early birds who believe that the real estate crisis may end anytime soon, and they're buying into it. Another surprise you may see at the bottom, because Bitcoin actually in the second quarter was the worst performer, minus 14%. But for the year, it's still 50% up. Yeah, so and there you may see already the early stages of some sort of a rotation. Now, if we look to the calendar for the third quarter, it's the same themes all over again. You know, we obviously watch central banks with the ECB, perhaps next meeting, not immediately another cut, but perhaps later on in the third quarter. They might do it again. The Fed, it's now a bit, analysts are divided. Will they cut in September or in November? That's definitely on the cards. But with the weight of the big tech companies in the indices being so high, we look at corporate events. Earnings season starts off with JP Morgan in a bit of time, but then Nvidia is on the cards. And for the Tesla lovers amongst us, there is a robo-taxi presentation coming up on the 8th of August. Well, for the rest, it's obviously inflation data, macroeconomic data that can point us towards perhaps any further cuts.
Yeah, thank you, JP. It's certainly been an interesting last 3 months, but something tells me the upcoming 3 months are going to live up to it. But what are we looking at? What are we focusing on? What is our outlook for quarter 3?
Yeah, it's more of the same, but it's important. We had perhaps expected the Fed to be closer to a cut. As I said, the macroeconomic data were too good for now, so they take a cautious approach. They didn't do it yet, but you clearly see from the numbers that it's softening. So we expect it to move closer to a first cut in the third quarter. And again, we look at corporate earnings, because that is really necessary to sustain the equity bull market rally. Important factor that can go a bit two ways is the AI adoption, because at present, there's a lot of investments going in. I just talked to you about 200 billion only for the big techs, but that has to materialize in revenues and profit, right, at some point. So if that's delayed, then the market can get a bit of a scare. On the other hand, if it's again as positive as we've seen in the previous quarter, it can sustain the rally. One thing I'd like to highlight in particular, that's not too often talked about, is what you could say the decoupling between the US and its allies and the East, China and its allies. And it seems to gain pace. We've seen in the last couple of weeks tariffs being introduced on EVs, for example, the US pushing for additional export restrictions on high-tech gear, and also China selling some US government bonds, because they may fear at some point, they look at Russia and say, well, if they freeze it when we do something that the West doesn't like. But on the other hand, it's important to realize that this has definitely a political side, because trade across the globe still goes on everywhere where it's not too sensitive. And that's good for the economy, and that's also good for the markets, I'd say. To single out one specific other thing, we've seen in January what happened to Bitcoin after the introduction of the Bitcoin ETF. And now, perhaps as soon as the beginning of July, we may see the start of trading of the Ethereum ETF. And that is also an item to watch closely in the coming weeks.
Yeah, thanks, JP. Let's actually now move on to some of the online survey results that we've got, which are completely through eToro. So we're looking here at retail investors, which I think is really, really interesting. JP, what stood out for you from this report?
Yeah, it moves more to the extremes. And as you say, I like this part always best because we really get the views of a retail audience that you don't see at many places. And you see it also from the number of respondents who have taken part in this. But it's moving to the extremes. You see that on the most favored asset class, where crypto was actually halved from the previous quarter. And overtaken by stocks. Stocks is clearly the favorite asset class among this group of people. For the rest, what you see is that they look even more into the US. We thought it was already quite high, but it's going up still. And you see that also with technology as the favorite sector in the left-hand bottom. If you look at the themes, more of the same. Disruptive tech is what everyone looking for. And, within our analyst team, We look at valuations go up. You say, will there be some sort of a rotation? Well, you here clearly see the retail view is that it can continue for a while.
Yeah, it's fascinating. And you know what? I love these surveys, love the community we got here at eToro. And that reminds me, if you're watching this or you're listening to this, get involved. Let us know in the comments whether you agree, whether you disagree, what you think about this survey as well. Let's get a conversation going. I think it's really unique what we've got here and should be celebrated. One area that obviously a lot of people are going to focus on is the US. So, Brett, this brings us on to you. Let's deep dive into it. How are you seeing the US at the moment? You're a man on the ground, so there's no better place for us to come to than to yourself.
Yeah, thanks, Sam. So when you look at the U.S. market, we saw such a strong start to the year, right? The S&P was up 10%. 10 out of the 11 S&P sectors were higher on the quarter. In Q2, we still saw that strength in the S&P. It rallied. Rallied almost 5%, but we've done it on narrowing leadership. Only 4 out of the 11 S&P sectors have been higher in Q2. And we're seeing a lot of that strength rotate into tech, into communication stocks, interestingly into utilities, which I'll touch on in a little more detail in a minute. But even though we've had that narrow leadership, the S&P continues to perform well, and there's still a hope that the Fed can orchestrate a soft landing, right? Which is defeating inflation to bring down rates and without causing any harm to the labor market or the economy. When we look at the recent data, say the last 6 to 8 weeks, we have seen some softness in the economy, whether that's on the jobs front or retail spending, but it hasn't been catastrophically weak. Some softness is actually a good thing. We need the economy to slow down a little bit in order for the Fed to justify lowering rates and to kind of take some of that pressure off of inflation. And JP mentioned that the ECB has already moved, and now the expectation is that the Fed will cut rates later this year. Sometime in the second half, expectations are for 1 to 2 cuts at the moment. We'll see how that kind of shakes out. But the bigger picture story is that the Fed will cut rates. It's just a matter of when, not if. Yeah. And that sets us up for lower rates in the second half of this year and lower rates in 2025. And when you combine that with the fundamental backdrop for the S&P, which is solid earnings growth, the bulls still have a pretty solid case to make for higher prices over the long term. When you look at the earnings growth for the index, JP also just mentioned we came off a very good quarter in Q1, but Q2 expectations call for an acceleration up to about 9% growth, similar for Q3. And then in the 3 quarters following that, so Q4 and then Q1 and Q2 of next year, call for double-digit earnings growth. So the runway is there for higher stock prices, for stronger fundamentals. Obviously, there's always the risk that the labor market deteriorates or the economy breaks down more than expected, and the Fed would have to be forced to intervene, and investors would have to recircle a little bit. But as of now, the backdrop for the U.S. economy remains fairly strong.
Moving on to... Sorry. Yes, sorry, I'll go. And then moving on to your second slide here, Brett, you said you were going to talk about utilities and then continue to outperform. Is that the way you're seeing it?
Yeah, utilities are a fairly interesting sector. First, they don't ever get much love. It's kind of flies under the radar. It's not a particularly sexy sector, but for once, it's not just defensive positioning driving this group higher. There's an interesting component to it, which is an AI component. While they're not developing the tech, they're not building the chips or the software. The companies that are running these giant programs, these AI programs, need a power source for it, and that's an increase in energy, and it's expected to be a driver for utilities. Obviously, not all utility stocks are created equal, but as a sector in general, the expectation is that it will be a positive. And aside from that, they also have 2 other narratives working in their favor, which the first, as we just discussed, was the expectation for falling rates. So utilities tend to be more defensive, as mentioned, but they also they're rate sensitive. So as rates come up, this group struggles, and as rates go down, it tends to outperform. So lower rates would be a positive for utilities. And additionally, they too have strong earnings growth. The sector's working off 3 straight quarters of double-digit earnings growth. And Q2 is actually expected to be pretty close to flat, which sounds like a negative, but to me, I think it could just be a pause. Maybe gives this group a chance to pull back, gives investors a chance to buy the dip. And when we look out further, the earnings accelerate again for the next 3 out of the next 4 quarters. So there is a positive there, and it's not just tied to investors being anxious or scared, looking for cash flow. There's actually some drivers behind it, and you would think that maybe the valuation is a little stretched given how well utilities have performed this year, but the valuation on a forward earnings basis is actually pretty reasonable still. It's below the long-term median, which is about 18.
Thank you very much, Brett. And again, please do, for those that are watching at home or listening on their way to work, whatever it is, please do let us know how you're seeing things in the US as well. Be really interesting to hear from you all. And also do remember, digest and invest. There's, places for everything, any podcast or video or guide on the Academy as well. Please do check all of that out. Neja and I actually just recorded the latest Market Bites, which brings me on to Neja. It's great to have you with us. You've been tasked to talk about Magnificent Seven and gold. Is the US market too concentrated there, Neja? What have you got for us?
Yeah, first I would like to talk about Magnificent Seven. As you probably know, in the past 18 months, Magnificent Seven have dominated headlines and due to their impressive performance. And at first, I would like to take a quick overview of those companies. If we start with NVIDIA saw a massive 260% sales growth in the first quarter that was driven by AI. And they recently had a stock split that was in the beginning of June. And all of that broadened investors' access, and it added even more to 150% surge in its share price. If we continue with Microsoft and Amazon, they both benefited from strong cloud growth and AI advancements. Both stocks are up more than 20% this year. And Alphabet reported strong first earnings, and that earnings were driven by gains in Google Cloud and advertising. Their stock is also up more than 30% this year so far. Meta also reported solid revenue growth in the first quarter, but increased spending on AI initially worried investors. That's why their stock dropped by 15% after earnings were released, but it's already rebounded. It is up more than 40% year to date. And Apple, they recently held developers conference. I'm sure that many of you watched that. And there they introduced AI to their products, and all of that boosted investors' confidence. So Apple stock is currently up about 12% year to date. Among Magnificent Seven companies, there is also Tesla, and this is the only company among them that is currently struggling. It is down 25% this year, and recently shareholders voted and approved Elon Musk's big compensation package. Here it is worth mentioning that retail investors played a big factor here, and their decision actually reflected their confidence in leadership, even though the company is currently facing some challenges in electric vehicle sector. So all of Magnificent Seven dominance and strong performance arises some concerns about SP 500 reliance on only small number of companies. They altogether actually represent over 30% of SP 500, and they were responsible for more than half of SP 500 24% increase in 2023. So that is quite a lot, because if we would exclude them from SP 500 last year, SP 500 would be up only about 10%. And all of that suggests that the index overall performance may be somehow misleading. I also heard that people started comparing Magnificent Seven with dot-com bubble in the 1990s. But I think that it is important that we mentioned some important differences here, because Magnificent Seven have these established market positions already, and that they generate substantial earnings and cash flow. And unlike this speculative era of dot-com bubble, where many companies only relied on future promises, Magnificent Seven earnings are already slowly boosted by AI. So that is some difference that we have between dot-com bubble and current situation. Now, the key question here is how long can Magnificent Seven sustain their current growth, and what lies ahead for them this quarter. Because these tech giants are leaders in innovation and disruption, but they also face some risks in these fast-moving industries, and that includes tough competition and also fast-shifting consumer preferences. And although their strong performance may maintain these high multiples and stock prices, there is a pressure for meeting high market expectations. And because of that, they're more exposed to market volatility and potential price drops. Their earnings report can also significantly impact their stock prices. And not only that, it can also impact the overall market as well. So that is why many investors wonder what to do in times like that, because our view is that it is valuable to remember that there are opportunities beyond Magnificent Seven, and looking beyond this top performance can reveal some opportunities, some companies with strong business models, or even companies with long track record of paying out dividends. And that's why it may be wise to consider diversifying a portfolio by including both fast-growing companies and also those that are currently lagging behind but can offer us some other benefits. Now, if we move on to my other topic, some other asset that is also performing pretty well this year, and that's gold. Gold hit a record highs above $2,400 per ounce. That was in late May. And now it is trading just under $2,300 per ounce. So year to date, it is up about 10%. And this surge can be explained by several different factors. Firstly, gold typically moves in opposite direction to US dollar. And the Federal Reserve, this choice to maintain interest rates as they are for now and decrease monthly asset purchases has made gold more appealing despite lower yields. Secondly, we have geopolitical tensions. They have strengthened gold's appeal as safe haven. And there are also central banks, especially China, for example, that are increasing gold reserves, which has positively impacted gold prices. Now, looking ahead, we remain cautiously positive on gold. Ongoing political instability and economic uncertainty could sustain gold's status as safe haven. However, its future trajectory will also depend on market dynamics, such as upcoming central banks' decisions and global market conditions in second half of the year.
Thank you very much, Neja. And for those, again, listening, watching, let us know what you think about gold. And I also want to hear from people that believe NVIDIA is very similar to Cisco as well. Want your reasons why you might think that. I always find those opinions interesting, and look, they're completely valid if you can back it up as well. JP, before we get to our Q&A section, which is what we usually do, let's just quickly run over the outlook for the remainder of the year. How are we seeing it?
Yeah, and this is pretty much our eToro longer-term outlook that we've presented so far. And the good thing is that we didn't need to change it much this time.
Nice.
But, with the presentations that you've just heard, to elaborate on Brad, to build forward on Brad, what you see in the US with respect to expected earnings growth, the same is true for Europe. The higher tech goes, the nearer we believe that the rotation is there. And that would be a healthy thing. You see the first sparks of that moving out a little bit of tech, a little bit of profit taking into other categories, like, cyclicals, like perhaps Europe at some point when the Fed actually does cut and the dollar softens. We may see also some investments go to emerging markets. So it's very clear that we don't believe rate cuts are off. Even if you once in a while see a number on inflation that you say, oh, would there be a rate increase again? We don't see that. We believe the cut is the next thing, like the Fed says as well. And the important part of our view is that will put cash in motion, because there is still something like $7 billion in money market funds that now profits from a relatively high rate. And if that comes down, it could seek for more return in other asset classes. Yeah, that would mean at some point the dollar would peak as well, and that would also soften the environment, for example, for commodities. Yeah, so for the remainder of the year, a rotation into cyclicals is really on the cards, and that is particularly something in Europe, as I said, where we already saw a first cut, that we may see that moving perhaps there as well. So a lot of focus on the next earnings season, with again the special mention for crypto with the upcoming ETF launch on Ethereum.
Yeah, amazing. Well, look, we'll be back in 3 months to review this again. But before we do that, we've got our usual Q&A. Now, the rules are you've only got a minute to answer these questions, so no pressure. Brett, I'm going to come to you first. Are rate cuts the most important catalyst to watch in the US?
Yeah, I would say that rate cuts are a key catalyst to watch in the US, but I would say that they are not the only catalyst to watch in the US. I would have to remind investors that coming into this year, the market was pricing in 5 to 6 rate cuts, and the market rallied pretty well on that expectation. But now we're down to 1 to 2 cuts, and the S&P is still at or making new all-time highs. So it does matter, but it's not the only thing that matters.
Yeah, good answer. Let us know in the chat if anyone thinks we are not going to get a rate cut this year, and give us your reason why. Be interested to hear. Neja, I'm coming to you next. How should one deal with such a situation where the Magnificent Seven represents all the increase in the index?
Yeah, that's a good one. I think there are many options, and a lot depends on investors' risk tolerance and how prone is he towards volatility. Because right now concentration is pretty high, and concentration is a high risk because the index is majorly focused only on a small number of companies. And in case of fundamental change, this company could affect index correction. That's not necessarily a bad thing. That could even open new options for us who are investing on the long term. But if your tolerance for risk and volatility is lower, there is also a S&P 500 equal weighted index, where every company in index is equally weighted at 0.2%, and that kind of eliminate the concentration on Magnificent Seven, but you still get some of the exposure.
Yeah, amazing. JP, this one has just been sent in over the last couple of days. The outlook for equities is still positive, but doesn't a pullback like we've seen in Nvidia, the round sort of 10 to 15%, doesn't that scare you?
No, not at all. As long as these twin pillars under the equity rally are still in place, earnings still strong. We see them being stronger for the remainder of the year, and cuts are not postponed, or are not off the table, but they are postponed. So that's a good thing. If you look back in the first half of the year, we saw one pullback of 5% when you look at the S&P 500 in the second half of April. That's healthy. Yeah. And what you now just saw on Nvidia, it's healthy, but you also see immediately investors stepping in because they believe it's a good moment to buy the dip.
Yeah, I'm with you. Brett, the S&P 500 is up about 15% or so far this year. Will small caps come along for the ride too, or will it keep lagging?
Yeah, we saw small caps trade really well in the fourth quarter of last year, and that was on the expectation of lower rates. And so far this year, small caps unfortunately have been a bit of a laggard. And the valuation, especially relative to its large cap counterparts, has continued to get more and more attractive, but that has not been the catalyst apparently that group has needed. So on a valuation basis, small caps remain attractive, but they do seem to need a catalyst. The hope would be that catalyst comes sometime in the second half on the idea of lower rates, and we start to see some money rotate out of our leadership names and sprinkle through the market, including small caps.
Yeah, thank you, Brett. You have answered both your questions under a minute, so you've passed, and we'll see you again in 3 months' time. Neja and JP, we've got one more left for you each. Neja, we'll come to you first. What is your view about the rest of the year when it comes to commodities?
I'll try to be short. First, we have to know that commodities are strongly dependent on geopolitical and macroeconomic conditions. I think that everyone here knows that, but for gold now is very resilient as interest rates are staying at the same levels. And in current conditions or even easing interest rates, we could see gold even a bit more higher. But in other hand, in other scenario, if inflation starts rising again and if central banks have to tighten again, we could see some more pressure on commodities and gold in particular. Overall, I would say that we are positive on this asset class for the second half of the year, but only if those factors that I mentioned won't change.
Yeah, thank you. JP, then last question for us today. What is the next event to watch in the crypto markets?
Well, I think the next event, we already mentioned it, is the trading start of the Ethereum ETF. We don't know the exact date, but it should be coming up fairly soon. But let me answer that as well to say, a core principle in investing is diversification. And what you currently see everywhere, there is concentration risk. You also see that in the survey results that we presented today. Yeah, so for each and every one, if you're concentrated, whether it's completely in tech or completely in crypto, you may want to look at other asset classes as well. And with crypto, you see now institutions stepping in as well because they recognize that the diversification is important from the big markets they already follow. So that's a key takeaway, I think, for this quarter.
Yeah, I'm with you on that. Very well said. And that really brings us to the back end of the session. I hope everyone enjoyed the webinar or podcast, depending on how you watched or listened to it. And do remember, you've got the eToro Academy for everything you could possibly want. Guides, videos, blogs, courses as well. And of course, you've got all the usual podcasts with the Market Bites, Conversation with Leaders, Trader Talks, and Stock Break as well. JP, Brett, Neja, thank you very much for joining. And we'll see you all again in 3 months' time. Thank you, guys.